They called him the golden boy of Wall Street, but today, Kevin Warsh is being called the architect of the 2026 recession. If you have noticed the sudden, violent drop in your stock portfolio or the way Bitcoin is struggling to breathe, you are witnessing the birth of the Warsh winter. For years, the global market was fueled by the Powell pivot, the idea that the Federal Reserve would always step in to print money and save the day. But that era ended the moment President Trump nominated Kevin Warsh as the new Fed chair. To understand why your money is at risk, you have to understand the man now holding the steering wheel of the global economy. Kevin Warsh is not your typical central banker. He is a hawk in the truest sense of the word. While previous chairs focused on keeping the stock market happy, Warsh has a different priority: the absolute stability of the US dollar and the destruction of inflation, no matter the cost. His philosophy is simple yet brutal. Easy money creates bubbles, and bubbles must be popped to save the economy in the long run. This shift from dovish to hawkish policy is the single most important event in finance right now. When we talk about a hawkish Fed, we are talking about the cost of money. Think of interest rates as the price of admission to the global economy. For a long time, the price was cheap. Companies borrowed billions to grow, and investors used cheap debt to buy stocks and crypto. But Warsh is raising the price of admission. Higher interest rates act like a brake on a speeding car. When the Fed signals that rates will stay higher for longer, it effectively sucks the oxygen out of the room. This is why we see a liquidity vacuum happening across the globe. Investors are no longer looking for the next moonshot crypto coin. They are rushing to park their trillions in US Treasury bonds because they now offer a guaranteed high return without the risk of a market crash. This has created what economists call a deeply inverted yield curve. Historically, this is the most accurate recession predictor in existence. It happens when short-term interest rates are higher than long-term rates, signaling that the market has lost faith in the immediate future. Every single time this has happened in the last 50 years, a recession followed within 12 to 18 months. We are seeing the signs everywhere, from the cooling job market in the US to the massive slowdown in European manufacturing. For India, the impact is even more direct. As the Fed tightens the screws, foreign institutional investors, or FIIs, are pulling their capital out of emerging markets like the Nifty 50 to take it back to the safety of the dollar. This is why even good corporate earnings in India are being met with selling pressure. But the Warsh recession isn't just about falling stock prices. It's about a fundamental shift in how wealth is built. In a recessionary environment led by a strong dollar, the old rules of buy the dip can be dangerous. When the Fed is actively trying to cool the economy, a dip can quickly become a cliff. We're moving from a growth at all costs market to a value and cash flow market. This means the high-flying tech stocks and speculative AI companies that dominated 2025 are now the most vulnerable. Investors are now looking for defensive moats, companies that provide essential services like healthcare, utilities, and consumer staples, because people still need medicine and food even during a recession. So, how do you navigate this Warsh winter without losing your shirt? The first rule is to respect the trend. You cannot fight the Federal Reserve. If the Fed is tightening, you must tighten your own strategy. This is the time to audit your portfolio and remove the dead wood, those speculative stocks you bought purely on hype. Second, you must understand the dollar hedge. When the dollar index, or DXY, rises, it puts a ceiling on gold and crypto. You need to wait for the DXY to stabilize before making any large buy moves in those sectors. Lastly, remember that a recession is not the end of the world. It is a reset button. It clears out the weak companies and the zombie corporations that only survived on cheap debt. For the disciplined investor, this is the most important time to build a watch list of high-quality companies. When the panic reaches its peak and the headlines are at their most terrifying, that is when generational wealth is truly made. The Warsh recession will be painful for those who are over-leveraged and unprepared, but for those who understand the mechanics of the Fed and keep their liquidity ready, it will be the greatest buying opportunity of the decade. Stay patient, watch the yield curve, and most importantly, keep your emotions out of your trading terminal. The winter is here, but those who prepare now will own the spring.